All right, so Vince, we just had a bunch of headlines really involved in the tech space. A lot of questions about what's going to happen when it comes to those export curbs when the administration takes a look at it. Some questions about Apple as well. So I just want to ask, what's your view when it comes to mega cap tech and the Mag 7 in particular with so much uncertainty? And let's not forget, the pause on tariffs expires in about 2 months.
Yeah, well, there's certainly a lot of things to analyze this week, Frank, as you mentioned. And we've got Fed news, we've got tariff news, and we've got a lot of earnings analysis to go through. So I think at a high level, when we think about mega cap tech, two things inevitably happen. When you get as large as Apple and Google and Meta and some of the others, you inevitably have a harder time growing, just the law of large numbers. The other thing that tends to happen is the government gets involved. They start to look at monopolistic tendencies and some of the antitrust considerations in Europe and now in the U.S. are going to impact these companies. We think they're still the backbone of the U.S. economy. I mean, large cap, mega cap tech is going to really epitomize the growth of our economy through AI and through our daily utilization. We know that the percentage of large cap tech in the S&P 500 is very high. We think there's good reason for that, but we do need to navigate some of the near-term volatility around tariffs, earnings, and of course the Fed policy.
All right, so when you're talking about navigating near-term volatility, are you getting more defensive when you're looking at the market right now? So our data team put out some stats, a number of very defensive companies hitting 52-week or all-time highs. I'm talking about cigarette makers like Altria and Philip Morris, also some healthcare names, Cardinal Health, Cencora, which used to be AmerisourceBergen, and also McKesson. I mean, these are pretty defensive names right here. What do you make of these companies, again, hitting 52-week or all-time highs during this current environment?
Yeah, one of the things we're trying to do as active managers is navigate the long-term opportunities with the near-term volatility, and it is directing us into some of the companies that you just mentioned, Frank, in particular Philip Morris. So I manage 2 ETFs, and we disclose all the holdings on cloughetfs.com. You'll see Philip Morris is one of the larger holdings. We also own defensive companies like an SCI, a funeral and cemetery business, just to give you an indication of the defensive nature of some of the businesses we're looking at. They have subscription models, revenue models, big balance sheets, kind of predictable cash flow and earnings. So that, to us, is comforting in a period of accelerated volatility.
Yeah, certainly predictable cash flows. I mean, I think Benjamin Franklin said 2 things are certain in life, death or taxes. So that's certainly a pretty predictable business model there. One other thing I want to talk to you about, Vince, before we let you go. Obviously, we had the Fed meeting yesterday, left rates unchanged. Jay Powell said a lot of uncertainty out there. The Fed's really trying to figure everything out. Note from Goldman overnight. I want to get your take to what they had to say. They said, in part, after the Fed left the rates unchanged, this means that there are no easy answers about the Fed path for now. Our best guess continues to be enough evidence of weakness in the labor market and other hard data will accumulate by late July for the FOMC to deliver 3 25 basis point cuts at the July, September, and October meetings. Do you agree with this thesis that we got 3 cuts on the way and they're actually going to start this summer?
We do think rates are going lower, Frank. And it's hard to be too precise about when and by how much when you're talking about the Fed. But if you look at the real rate of return, if you wanted to go to a local bank right now and give them a demand deposit, the rate's going to be exceeding low. I mean, the real market is telling us that rates are low and going lower. When the Fed steps in and navigates their own dual mandate, right, is going to be, a matter of the data and their reactive posture to some of the data that comes in. As they increasingly focus on growth concerns and worry about the labor market, we think that elevates the likelihood that they're going to move sooner rather than later. But we think the broader trends on demographics and the secular decline in interest rates is still intact. So we would be thinking rates are going to continue to go lower.